I want to take today to do a bit of an update on the economy. Of course, there is a bit more optimism on TV economically since we've had a couple of good days, a few good days actually. I guess a better part of over a week now in the stock market. The S&P, as I record this, is sitting around 2,700, which is about 700 points off the all-time highs set in February, but it's significantly up from the bottom of about 2,200. And so we've had this massive 600-point rally. We've closed the gap by half, between the recent top and the recent bottom. And if you turn on the likes of CNBC, they'll tell you that the reason for this is because traders, meaning actual real human beings, not algos, I guess. It's never the algos that they talk about when stocks are going up, but that's a story for another day. Traders, they say, are optimistic because the deaths from or the new cases of the Wu flu are tapering off. We're seeing progressively less new cases and less deaths. To varying degrees in places like Italy, Spain, and even New York. Although in New York it's still early, and I haven't been following the day-to-day statistics as closely as I had been over the last few weeks. But there still seems to be a possibility that New York is going to continue with even more daily cases and daily deaths. But something that not a lot of people are pointing out is the role that the lockdown is having in this. To see, when you institute this kind of a national lockdown in the case of Italy and Spain, and localized to a certain extent lockdown throughout the United States, but a lockdown of pretty much all the areas of the United States that have dense populations, you're going to see a slow in the rate of infection, a significant and sharp decline in the rate of infection, after the first couple weeks of, isolation and of quarantine. This is different when you see a slow in the rate of infection of a virus that is just spreading freely throughout the population with no so-called non-pharmaceutical interventions to try and slow the spread. The reason for this is that when a virus is completely uninhibited, it's only going to slow because of one or two factors, either seasonality, which from what we've seen doesn't seem to really affect this virus. It doesn't seem like warmer climates or summertime are hurt the virus that much. It still spreads very rapidly. So that's off the table as a reason why the rate of infection for decline. And the other reason is herd immunity, because so many people have gotten it that there can't be that many new cases. We've reached a critical mass to where so many people have had it that it's becoming hard to spread to new people. But if you put a lockdown in place, and you have this kind of an intervention, you can start bringing down the rate of infection because you've made it physically less possible to spread the virus. But that doesn't mean that from now you can expect to see a sharp decline and then the virus goes away forever. Because if you bring down the rate of infection through these artificial means, you have not achieved herd immunity. To see that the rate of infection is coming down doesn't mean in this case, that we've rounded the bend and now it's we're out the other side. It's not like we're halfway through this. If you slow the rate of infection through artificial means, what you're doing is you're lengthening the period of time of the pandemic. This is the point of the whole strategy. So the fact that Wall Street is all optimistic because the rate of infection is slowing, and they're like, oh, well, this is a good thing. This means that we're going to be able to get back to work sooner. No, it doesn't. It means that you're going to be the slower that the rate of infection is, the longer it takes to get to herd immunity. So in terms, from an economic standpoint, that means a longer lockdown. Because if you come out of lockdown and start loosening restrictions without herd immunity, well, what's going to happen? And rates of infection are going to spike straight back up. So, for CNBC's story to really work here, for their narrative to hold true, either traders, there's only one way that it holds true. Traders just must be really dumb. And all these people are just buying stocks mindlessly, on false optimism. That is a possibility, but I think it's more likely that CNBC is just kind of dumb, and they're overplaying the role of human traders here, or at least overplaying the role of the market and market forces. As I've talked about before, they seem to be very fond of this whole efficient markets hypothesis, to where changes in prices in a market are, a factor of information and changing news. And I guess they're biased, since they are in the news business. They want to believe that the things they're reporting, is what's moving the price, and that they are an integral part of the market process. But in reality, something that seems much more likely to me is, you look at the unprecedented Fed intervention, the elephant in the room, the reportedly $1 million a day in financial asset purchases that the Fed is buying up. Oh, I'm sorry. Did I say 1 million a day? I meant to say 1 million per second. Okay, so times 60 seconds, that is 60 million a minute, or times 60, 3.6 billion per hour, which should equal about 86.4 billion per day. Now, as I've discussed in the past, the Fed isn't directly going in and taking this $86.4 billion a day and buying up stocks, but what they are doing is they're buying up other, asset-backed securities, mortgage-backed securities, student loan debt, I believe they can do now, a corporate paper, pretty much any kind of debt in the market. They're buying up and pushing down yields. And so when the Fed pushes down yields in the debt markets, when people can't make money in bonds because interest rates are too low, well, what do? They have to chase yields in the stock market. So by dumping money into the bond market, the Fed obviously is pushing money into the stock market. This isn't hard to figure out. Now, the interesting thing about this is that, as we've seen in the past, once the Fed, embarks on a program of easing, they can never, take that back. They can never tighten after they ease. After QE, the Fed was unable to unravel their balance sheet and to stop buying things and to essentially let all of the debt on their books sort of just roll off without buying up new bonds to replace them. That led back in 2018 to the start of a great crash, which the Fed only was able to reverse. There was also, I should point out, was also sparked by the Fed trying to raise interest rates. The Fed ultimately had to abandon both of those things long before the Wu-flu crisis and go back to easing. And now with the Wu-flu crisis happening, they have gone, absolutely nuclear with their easing. And so none of this is reversible. But what's interesting to me is that while the Fed did originally they would use their manipulations and their injections of liquidity to try and be as indirect as possible in influencing the market. And every time that the Fed has had to go back and double down on this whole QE venture, they have had to get it down, deeper and deeper in the gutter and be more involved directly in the economy. And that's why now, you see them buying commercial paper, as well as mortgage-backed securities and treasuries and everything else, because they're not just propping up one segment of the market directly and then indirectly propping up the rest of the market. They have to, every time, play a more and more direct role. And so every time that this happens, we're getting to a point to where eventually the Fed will be the only buyer. And it should become increasingly obvious, even to ordinary people, that so-called markets are a fiction. We have no markets. It's all a circus meant to entertain politicians, voters, and viewers of CNBC. This is truly the greatest experiment in central banking that has ever been undertaken. And it should answer once and for all the question as to, can we really just print our way to prosperity? Is it possible to print money without actually, changing anything in terms of production, without, building more factories or selling more goods? Can we really prosper just by printing money? Because if the answer is yes, as much as I am a doomsayer when it comes to this kind of stuff, I'll be happy. Because you know what that means? Nobody has to work. We can just print money for everyone. Who cares if we have 30% unemployment, okay? Because we can just print everyone a free paycheck. We could raise the minimum wage to $50 an hour. Whatever your employer, is willing to pay, plus some money from the Fed, it should just be brought up to $50. Hell, why should your employer pay you at all if the Fed can just print you the money? As ridiculous as this sounds, these are real questions that will have to be answered if our new paradigm, really does stick here. So with that said, if you get anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.